Let's welcome in our next guest, Vibhav Kapoor, Group CIO, IL&FS, is now joining us live. Vibhav, thank you so much for taking out time for us. Could you just tell us that, what happened into the markets yesterday? Do you think valuations are very, very high? You saw global uptick in the in bond yields, and that probably just led to a profit booking across emerging markets?
Yeah, I think some profit booking was anyway due, or rather overdue, because the markets have been running very hard over the past several weeks now, and they've gone up by more than 13-14% from their lows in December. But overall, I think that between, say, a Nifty level of 85, 8600 and 8900, 9000, the markets are reasonably fairly valued and probably need to consolidate for some time before they make their next move up. Overall, the trend is bullish, the sentiment is bullish, and I think if the UP election results are favorable for the BJP, you can see the market break out of this range after that.
Right, but as you said, that market valuations are fair, so you don't expect a lot of big buying to come in unless there is news flow which indicates that sentiments or earnings could improve?
Well, as I said, yeah, one of course could be the election results, which could, push the markets at least maybe 4-5% above the range I'm talking about. The other point is that, globally, things have actually improved a fair bit in the last few months in terms of growth. So, Chinese growth has stabilized, Europe is starting to grow better, US obviously is doing well. Emerging market growth is coming back, and coupled with that, interest rates are still very low. So while you said that, yesterday's correction could be partly because of bond yields going up, while that may be true for a day, the fact is that, overall interest rates in the global economy are still very, very low. And therefore, a scenario of improving global growth combined with low interest rates is a very, very heady mix for equities.
Right. So lower interest rates, if that continues, or even if there is a marginal sort of a hike of 100 basis points over next 2 years by Fed or any other major authority, you think equity valuations will be on the higher side?
Yes. So, as long as growth starts to pick up, while interest rates and bond yields obviously will go up if that happens, and central banks will raise rates. But I think they're at such a low level right now that, as you rightly said, even a 50 basis point or a 100 basis point increase will not take them to very high levels. And therefore, the climate and sentiment for equities will remain positive as long as that happens. And valuations, therefore, could remain on the higher side everywhere.
Every time when we talk about markets, people compare the market valuation with the historic valuation. Now, if you look at the interest rates globally or liquidity scenario globally, don't really think that this has happened in the last 15 years. So historic valuations, or what markets was trading at earlier, really cannot be compared to the current valuations?
Absolutely. I think that's what Warren Buffett said the other day also, that, for example, in the US, with interest rates below 1% or at around 0.5%, even current valuations are not expensive. But if interest rates were to go up, say bond yields in the US were to go up to 4% or higher than that, then obviously current valuations are expensive. So, yeah, I do think you need to, compare, not compare past valuations on a standalone basis, but you need to align them with interest rates, growth, and other factors.
Right. Let's talk about the flow activity or what's happening in the market. So I know you cannot comment on stocks, but something like a Reliance, which is a big heavyweight, it's been tracked very well, has actually started to do well. We've also had telecom, which was a big underweight sector, which has started to do well. So do you believe that markets is now shifting towards low value or slightly low or attractive stocks in terms of PE? Is that the fund flow change that you're seeing?
Well, when there is a lot of liquidity, as there is now, and we've seen a huge amount of domestic liquidity also in the markets, so this sort of rotation trade always keeps on happening. So, some stocks go up, then others go up, and obviously which have been left behind in terms of low valuations then tend to catch up at some point of time. So that's what's happening now. So this is, I don't think this is surprising at all.
But does that mean that, when liquidity is so high, markets are chasing any idea which are slightly on the attractive side? Do you think that, the liquidity is coming to a peak, which means that valuations may not increase from here, or maybe there is a correction in the markets?
No, see, small corrections, technical corrections will always continue to happen. So as I said, right now, I don't see a very large correction because 8,600, 8,500 and 8,900 on the upside, or 9,000 is a fair valuation range. So we are not very much out of whack as far as valuations are concerned. And with global liquidity and domestic liquidity, I think will still continue to remain strong for quite some time to come. And if you have some positive growth impulses, both globally as well as in India, the markets can continue to move up definitely.
Right. You speak to a lot of FII clients. Now, this time around, the difference in the rally has been that DIIs have supported the market and actually, bought stocks when they were on the lower side. For FIIs, is there a left out feeling in the market?
No, I don't think so. See, the FIIs go by a lot of other factors than just pure country allocation. So they have emerging market allocations. They have to see what fund flows they are having. And net, they have been buying. So it's just that maybe in the last couple of months, their buying has not been that strong. Also, when US interest rates go up, emerging market allocations always tend to come down. So to that extent, I would guess has been one reason why their buying has been a bit muted.
Right. In terms of emerging market valuations, or the recent move that you have seen, do you think flows into emerging markets would tend to be strong, which has been the case?
The overall liquidity in the global markets is very high. So some percentage of that will always keep on coming to the emerging markets. But if US interest rates start going up in a much faster manner than they have been so far, then that will definitely impact flows to emerging markets adversely.
Right. And in terms of developed markets, it's always talked developed markets versus emerging markets. Now, last 2-3 years, this, last 6 months or so, we've seen that developed market flows have been very, very strong. Or trade has been that, one goes overweight on developed markets and sell emerging markets. Do you think that can reverse, or earnings have to recover for that to reverse?
Well, earnings definitely need to recover for that to happen. That is one. And secondly, this benign interest rate scenario globally should continue for that to happen. If interest rates start to move up very sharply, then obviously the emerging markets will not do as well.
Right. We've spoken about interest rates and how it can impact the valuations. Let's talk about the earnings numbers. First, about the Q3 numbers. Did that surprise you on the positive side?
No, actually, we were, you'd be surprised, we were actually looking for higher numbers than we actually got. I think in the Nifty, we got a earnings growth of about 9%. We were actually looking at a higher number of 16-17%. But I think that got impacted just by one company, which was Tata Motors, which came where the results came in much, much lower than expected, and therefore didn't lead to that high growth rate. Otherwise, I think the numbers were in line, and we had always believed that the impact of the demonetization had been overestimated by the media as well as by a lot of analysts and other people. And in our view, even at that time, the demonetization was not having as much of an adverse impact as was thought out to be, and that's what has actually turned out to be. So I'm not surprised at all.
And in terms of FY18 numbers, do you think for markets they are realistic?
The analysts are always over-optimistic, that we've seen. And as time goes by and time comes nearer, you always generally see downgrades happening in expectations. But I think 15 to 17% earnings growth for FY18 looks quite possible and quite realistic.
Right. See, till now it's been private banks, it's been IT, I'm talking about the YOY growth that they have been delivering, and probably pharma, which has taken the markets higher, and some of the auto companies. Do you think if that 15%, 18% number has to be reached, some of the sectors like capital goods, metals, which were till not performing well, maybe PSU banks, they also need to show YOY sharp growth?
Yeah, you see, some of the sectors like metals and global commodities will actually show a huge amount of growth now because their base was low and commodity prices have started to move up very significantly. So FY18 should be pretty good for them. And then, of course, some of the other sectors like capital goods, yes, they do need to improve. But I think again, FY18 may not see too much of earnings growth in capital goods still. That may happen still later in FY19. So it's going to be a good mix between, some growth from IT, some from pharma, private banks, maybe some PSU, because last year the PSU banks had a very bad time, so the base is very low. Automobiles, some of the FMCG companies I think could start growing better again because rural demand should start to pick up after the demonetization last year. So all in all, it would be a well-balanced sort of sectorial mix.
Mr. Kapoor, while they may be on the top line, you're expecting 15 to 70% growth for FY18. Do you think profitability of companies could come under pressure because the global reflation trade is now looking very real? We're seeing inflation even in Japan going up. So when commodity prices are higher, yes, commodity companies' earnings will be stronger. But don't you think some of the profitability for FMCG companies, for auto companies may come under pressure?
Yeah, so the margins could be a little bit under pressure because of raw material prices going up because of the reflation. But I think if top lines grow well, then the operating leverage will kick in and that should help them keep margins steady.
Where do you think, what kind of companies have pricing power as well? For some companies, it's a direct pass-through of higher prices. But in some sectors like cement, there is just no pricing power. So which are the sectors you would avoid because you'd see their margins under pressure?
Yeah, so that is sector to sector, and obviously you would need to look at company to company to see which companies can pass on these raw material costs. But I think largely, if there is reasonable growth in the top line, which means that demand growth is there, then most companies should be able to pass on their raw material costs.
Right. You said you expected reasonable growth from IT and pharma as well when it comes to earnings in FY18. What could this growth rate look like? What makes you bullish about growth in, say, IT or pharma when they are facing a number of challenges in the main markets in the US? Could you give us a ballpark on what kind of growth on an average you're expecting from IT as well as pharma companies?
Yeah, so in IT we are not very bullish and I'm not factoring in a very high growth rate as far as IT profitability is concerned. I think you're right, there are a lot of issues as far as the IT sector is concerned. The only positive for IT probably is that valuations are no longer that stretched now and therefore stocks could still go up a little bit even if earnings growth is not that high. But we are factoring in about only an 8 to 10% growth in IT profits for FY18. In pharma also, yes, things are difficult. There are still a lot of uncertainties in terms of what Trump does in terms of import duties, etc. But I think as far as pharma is concerned, probably you're close to the bottom of the cycle and we are factoring in very moderate earnings growth of somewhere around 15%.
Right. What about the other export-oriented companies like, say, auto ancillary or even some of the chemical companies? Do you think they stand to benefit from global growth picking up? If anybody wants to bet on the export side of business, would this be the best bet?
Yeah, absolutely. I think, auto ancillaries, for example, you mentioned as a sector. The auto ancillary sector exports very significantly to Europe, for example, and European growth suddenly seems to be picking up now. Yes, some of these export sectors could benefit because of global growth picking up. I think, in fact, if you look at on a macroeconomic basis, India's exports have been pretty stagnant for the last maybe 12 to 18 months, a lot of it because of global slowdown. So that could start to improve as global growth picks up.
All right. For the domestic growth story, do you think consumption will again be the space that will benefit the most? And how will you look to play that space? Would it be through those companies that have a significant rural market? Will it be aviation names? Will it be FMCG companies? What do you make of the consumption theme?
So, yeah, I think consumption should start to improve again. One very positive factor for improvement in consumption is lower interest rates in the economy. We've seen interest rates come down pretty significantly over the past a year or so, and that should definitely help the consumption story. So as the impact of the demonetization goes away, and I think it's by and large gone now, and with the combination of lower interest rates and an improving global economy as well, I think the consumption story should start to play out well again. And obviously one of the or two sectors which should really gain from that would be FMCG as well as the automobile sector, and more particularly two-wheelers, which have not been doing so well of late.
Mr. Kapoor, earlier on you said that you expect strong earnings growth to come in from private sector banks and maybe even the PSU banks because the base is low. Now you're expecting a pickup in consumption. So how would you pick in the financial names? Would you still avoid those banks that have a large corporate book, because you also said that you don't expect capex to pick up in a big way anytime soon? Because some of the private banks, their valuations look pretty rich. So what do? How do you balance? Do you buy the safer bets with a large retail book, or do you take that risk of those PSU banks that have a large corporate book but valuations are very cheap? How would you play the financial space?
Yeah, that's a little bit of a difficult choice to make. So as far as the corporate banks are concerned, and that's the PSUs largely, as you rightly said, there is still a lot of uncertainty as to how their NPAs, etc., are going to pan out and how slippages are going to pan out next year. So I would keep a small percentage or a small weightage, maybe in one or two of the largest PSU banks, but still keep a much larger weightage in the private sector banks. So the private sector banks, which are largely, a lot of them, particularly the the retail book banks, should continue to do very well, particularly as the consumption story advances again. And while they are a little bit expensive, yes, no doubt, but they have, I think, a fair amount of growth ahead of them. So one wouldn't mind paying a little bit extra as far as they are concerned. The third part would be the NBFCs. Again, some select NBFCs which cater largely to the consumption story could also be definitely looked at.
Right. Vibhav, in terms of financials, the biggest thing for these companies was that loan growth continued to be very, very strong. But in the last 1 year, you've seen loan growth, the data which comes in, has constantly moderated. So do you expect that to pick up and that to be the next leg of growth for these companies?
Absolutely. So as the economy picks up because of the consumption factor, I think the growth in some of these financials will start to pick up, and that would be definitely a positive.
Right. Do you think that NBFCs would also continue to grow? Some of the NBFCs have got re-rated quite significantly. Do you think that still continues to be in sweet spot?
Yes, that's what I said. I think some NBFCs which are lending to particular sectors particularly should certainly do well once the sectors start to do well. So I would expect their top line growth to accelerate.
Right. But in terms of valuations, if you look at NBFCs, again, there is a very polarized market. Some NBFCs are trading at 4 times, 5 times. Some NBFCs are trading at, close to 1 times. So do you think that that will continue, like the difference between private banks and probably public banks?
Yeah, probably. But, some of the NBFCs are really trading at very, very high valuations. So I would definitely avoid those. And you need to make a proper selection in terms of growth, valuation, etc. But obviously, some of those which are very expensive or outrageously expensive, I at least would avoid them.
Right. If we look at NBFCs, the biggest thing going into their favor was that cost of funding was continuously declining. Now that the rates have become flat or become stable where they are, even RBI has changed its stance. Do you think benefit coming in from there for their EPS or increase in book value is on the higher side, is gone behind, and that's why these high valuations may not sustain?
Yeah, so that's correct. So, but we don't see interest rates increasing also in a big way in the immediate future. So I think they will remain steady, which means that margins can become steady while the advantage of those lower rates will no longer be there. But if the top line starts to grow, that is the rate of or the growth in the loan book starts to improve, that can really help in accelerating the profit growth of these companies in spite of the margins remaining steady and not going up further.
In terms of auto, what do you like? You mentioned about consumption earlier. Would auto, especially two-wheelers, would also be a part of that?
Yes, particularly two-wheelers, I think, because two-wheelers have had a relatively bad time, particularly after demonetization, because a large part of their market is in the rural areas. So I think now that the demonetization impact is over or getting over, I think the two-wheeler market should start to accelerate significantly going forward.
In terms of demand, do you expect when the demand would pick up, it would come back with a bang, or even the previous demand which has not been fulfilled because of which numbers were looking lower will start to come in when actually the market revives?
So I think it will be a little gradual. I don't expect a big bang. So over the next 6 months or 9 months, I think you will see this improvement happening. Of course, again, we'll come back to the monsoons, etc. later on in the year, and that obviously would also have an impact, and we'll need to watch out for that.
Right. What do you do with auto ancillary names? Do you think auto ancillaries would also benefit? We've seen a re-rating in the last 3-4 years. You think that will continue?
So, as I said, I think, auto ancillaries, a lot of those companies are export oriented, and particularly to Europe, and with European economies starting to improve, I think the auto ancillary should start to do well. And also, of course, if the domestic market starts to improve, that also should help them.